I'm going to start by looking at Tantalus Systems Holding Inc., symbol GRID or GRID on the TSX. The stock trades around $1.86, $83 million market cap, doesn't pay a dividend, but they're in a growth phase. What does Tantalus do? They're a provider of smart grid solutions to public power and electrical cooperative utilities. The company's hardware, devices, software, applications, and related services are designed to automate, monitor, and control power flow, consumption, and quality to improve grid reliability. Now, this first slide here should show you the last 7 years of business in terms of revenues and operating income. There's been moderate consolidated revenue growth, but nothing spectacular. And operating income has primarily been negative. Let's look at the share count over the same time horizon. There's a significant increase. It's slowed down of late, but over time, there's been a significant increase. The company, again, like I said, is in a growth phase. When you don't make any money, though, you have to fund operations either via debt or issuing shares, and the company has done both. So let's look at the recent Q4 and 2023 annual highlights. Tantalus generated its highest annual revenue in its history, 42 million US. That's about 56.8 million Canadian, 6% increase over the previous year. Revenue contributions from the utility software, applications and services segment in 2023 hit 35% of the company's total revenue. That's the highest percentage contribution in the company's history. Its annual recurring revenue, or ARR, was a record up to approximately 11.5 million US, 15.2 Canadian. That's 17% growth year over year. Recurring revenue recognized in Q4 represented approximately 24% of total revenue generated. Adjusted EBITDA was positive at about 0.35 million, about $500,000 Canadian. The Q4 compared to that was positive in Q4 compared to adjusted EBITDA of 0.1 million, approximately 0.1 Canadian for the prior year. Adjusted EBITDA for the year was approaching kind of neutrality, about 26,040K Canadian, 26,000 US. That was a loss compared to a loss of 2.4 million or a loss of 3.1 million Canadian in the prior year. The EBITDA, we would note, includes approximately 5 million US of further investment in its TrueSense Gateway, the product offering that is really the future of this business, and that was made throughout the year. Pull that out, and the company is saying it would be significantly more adjusted EBITDA positive. Now, let's look at valuations here. This is the balance sheet we're going to look at first. The positives here: cash is 5.2 million, debt is 11.4, and lease obligations of 3 million. So the company is in a net debt position. We can look at the valuations. That's a summary there of that. The valuations here, they're high right now on a trailing basis, 65 times EV to adjusted EBITDA. Forward looking, this is based on not our estimate, but one report that is out on this company is about 23 times PE. Well, there's no PE trailing as the company is not profitable. Going forward, the company is expected to do about $0.01 next year. So 180 times next year's earnings. Our conclusion here, simple. The positives for this business: Tantalus provides leading grid modernization technology that allows utilities to collect, manage, and analyze data. The company's platform directly supports decarbonization and the electrification of everything. It's gaining traction with a strong value proposition to regional co-op utilities, municipalities, and some investor-owned utilities. Now, the TrueSense Gateway is the future of Grid's product offering and provides the utilities next generational advanced metered infrastructure capabilities, improved power quality analytics, and most interesting, behind the meter access, among other features that it provides. Initial feedback has been from the early adopters. Its early clients has been very positive and confirms the product is addressing needs and needs that are out there of decarbonization, like we said, electrification and aging infrastructure. We like the business. This is our take finally here. The potential of the business we like, but the annual recurring revenue is still just for 15.4 million Canadian, and Tantalus remains cash flow negative over the past year. Our minimum criteria for investment is positive cash flow, and Tantalus has yet to achieve this. We continue to monitor the business, but found more profitable ways to invest in electrification and aging infrastructure through names like Hammond Power over the past 5+ years. All right, that's going to finish my answer on Tantalus today.
Great. Fluctuative revenue, no profitability, high valuation, EBITDA, all the attributes that you love.
Yeah, I mean, and it looks to be in a segment that has long-term potential, and there is growth in that recurring revenue base. But the recurring and the software base is still a smaller part of this business. I think the company has kind of caught fire at the start of this year, and while there is good potential, and it doesn't trade at a massive multiple to its sales, it's we need profitability, and we're not going to. Even if we like a business, like the industry they're in, see great potential in it, if a company is not profitable, we are not going to invest in it. That is one of our minimum criterias. And it serves us well because we're also looking not to lose money for clients. And a company that's proven they can make money is in a better position to make you money as a shareholder. I mean, in this case, they have to be significantly more profitable, even going forward, based on the estimates for us because the estimates going forward, which do look quite rosy, would leave it still trading at high valuations.
Yeah,
All right.
I mean, like the stock has, like you said, had a good run this year, but looking at generally the overall market, companies that are issuing shares, have debt on the balance sheet, and aren't profitable right now. Well, the market's just not been giving these kind of companies love. I mean,
Yeah,
for obvious
and
reasons.
we're going to sit down with management team in about 2 weeks because again, we like the story. They're at a conference we're at. We're going to sit there and gain further insights into the business, where they're going to go going forward. We've talked to them in the past as well. Often we'll monitor a company 4 to 5 years, especially in these stages before they become a recommendation. And most of them don't become recommendations because they don't meet our criteria and end up trading at reasonable valuations at the same time. So if that happens, maybe Tantalus makes us into our coverage. But at this point, we're continuing to monitor them. And when I say monitor them, we really are. We're going to sit down with management in a couple of weeks and interview the team.